Welcome to TheoTrade. This is Don Kaufman. It's February 28th, 2018. Doing the Theo Night video. There's still about 90 minutes left in the trading day. However, I really wanted to talk about market volatility. Now, whether you're an investor, a little bit of a longer duration, or a trader, whether it's, intraday or the next couple of days, I think I'm going to make some valid points, okay, for each and every one of you. So stay tuned as I go through this video, because we're going to be looking for a moment about investment products and really looking at, what the market has done thus far and what we can expect. But we're also going to look at, and what I'm going to start with here, is a little bit for the trader. Now, the reason I didn't wait for today's close is, first and foremost, I just need to point out this market is really in complete and utter limbo right now. And if you don't believe that, just look at the S&P futures. Now, again, looking at this on some video, it doesn't look like much. Well, we were up here and we came down here. Yeah, what is up here? That's all the way at 2762. We've actually come down here to 2737. And people, just the last few minutes, we've actually had a fairly substantial sell-off. I mean, that's 8 S&P points inside of the last about 6-7 minutes. Nevertheless, as I said, the markets are effectively in complete and utter limbo. Now, looking at this on a longer term perspective, all right, I just kind of want to zoom into what we've done thus far over the year. Now, this is also going to be effective for traders and or investors, but you have to recognize where we've come from and, ultimately where we're headed. But this year, we explode straight up. Okay, we fall flat on our face. We explode straight up. However, the entire time we've been exploding back to the upside. I've been on videos, day in and day out on the weekend updates, okay, proclaiming, listen, this volatility in this marketplace is far from over. As I just said a moment ago, the market's in limbo, and the market's going to be in limbo. Hey, listen, me saying that the volatility isn't over isn't me just proclaiming that volatility isn't over. It says it right in front of you. The volatility futures, okay, refuse to come out of their not only highly guarded stance, but the volatility futures are inverted. That means short duration volatility is exceeding longer duration volatility, and that's indicative of risk here and now. So moving forward, like if you have this like angst, if you have this feeling, you're like, I don't know what the next move is about to be in this marketplace. Good. You're not alone. People tune in day-to-day basis here to TheoTrade, and they're always looking for, okay, what's the market about to do? And I have no qualms whatsoever about telling you, okay, when I say the market's in limbo right now, there is no clarity to the future of the marketplace. If there was, the volatility futures wouldn't be flipped over right now. I mean, the volatility futures inverted is literally the professional world screaming, what's the next move going to be? They're actually asking the question. They're not telling you. All they're telling you is that volatility has increased, I should say. It has increased, and they've got no feel to the future. They're actually saying the risk in the present is actually greater than the future, if you will. And that is not something that is easy to deal with as an investor. So let's talk about the investor for a second. This is something that's not easy to deal with if you're an investor right now. And that means, you own a portfolio. And by the way, this is a ton of people. There's traders that are also investors. I'm one of them. I have longer duration holdings out there. But if you hold a portfolio, you should be afraid. Okay, and that's okay to say. You should be very, very afraid. And I'm actually going to show you why you should be afraid here momentarily. And you really don't in circumstances like this, okay? You do not want to sit here like the deer in the headlights. You need to make some very definitive decisions as to, if the market does X, I will do Y. Do not sit here at this point and just be like, well, we sold off a little bit. I mean, again, let's gauge a larger perspective of the S&Ps for a moment. And listen, don't worry about any of the drawings that are on here. Doesn't matter, okay? Let's gauge a larger perspective of the S&Ps and back up even a couple of years. We have come a long way, baby. And I think a lot of people, they succumb to the idea, it's all right, we can give back a little bit, but I'm going to stay in this thing, see if it bounces any higher. Well, I'm not talking to you to try to scare you out of the marketplace, but I'm going to tell you that as the volatility has increased, there's no cheap hedge left for you, okay? And what that effectively means is if you go look at the spiders and people are like, well, I can reduce my risk of a portfolio. What is risk reduction? For example, what do? You go out some 30 days, okay, and you open up an option chain out there to try to reduce risk. And some people want to go out there and they want to, buy like some put that's like about a 30 delta. Come on. Look at these 30 delta puts, all right? The things are trading like $2 and like 65 cents for like a 30 delta put. You want to pay $2 and what? 65 cents. Okay. And just do some quick math over here because this is where stuff gets fun. So you go out there and you buy some 30 delta put and you pay here $2.65. So let me just clear this and you pay $2.65. And all of a sudden you end up doing that 12 months in a row. Just want to make a quick point with this. Do that 12 months in a row and it amounts to like $31. That's $31 of a $275 product. Okay. Now you have to realize, do you really want to pay $31 a premium on a $270 product? Probably not, because the product, the S&Ps, have only been shown to appreciate about 8% in the average year. So, is it really worth it to hedge? And you're like, well, I can sell some calls. But again, the volatility right now has already spiked. By the way, going out there and buying puts, okay? Normally there's nothing wrong with it, but hey, right now, everybody sees the fire burning. Listen, we started this video and the S&Ps have already fallen a couple more points. I'm telling you, things, it's Mr. Toad's wild ride right now. But, you go out and buy some puts. You know what buying puts is really doing? It's reducing the risk of your portfolio. This is about a 30 delta. It's reducing the risk of your portfolio at that moment of time by about 30%. I just wanted to throw that out there. So if you're an investor, hedging right now probably isn't going to be right for you. And you might want to think, seriously might want to think about lightening the load of some of your portfolio. And people, that's okay to say. I'm not telling you to run for the hills with your 401k, but you better know what you're doing, because right now, where are you going to diversify to? Well, Don, I could get out of the S&Ps and into bonds. Oh, yeah, that looks like a great idea. Okay, and I'm not trying to be sarcastic with this, but hey, let's look at the bonds on a year-to-date percentage. Well, they were at 153, and now they're at 43. Or better yet, if you don't like the bonds, maybe people are more comfortable looking at the TLT. The TLT, okay, that thing is just fallen off, the edge of a cliff over here. On a percentage basis, this is not a happy ride. The idea of classical idea, I think, of diversification, some money in the S&Ps, some money in the bonds, yada, yada, yada. We'll sprinkle it around. Do you want to see how sprinkling it around has done for you? Okay, now we're actually going to go over to the spiders for just a second. And again, bear with me because I get pretty adamant about certain aspects because, again, the ideals, if you will, of classical finance, it's dead. It's ridiculous at this point. You're like, okay, what are we looking at over here? I will explain that momentarily, but I'm going to snap this just to a year to date because I want to look at it year to date, and I also want to make sure that we've got this thing set to line chart. Okay, let's explain precisely what we're looking at. It's a bunch of squiggly lines against the spiders. Now, what you happen to be looking at are major ETF products against the spiders. So these are all your major sectors, your major ETFs. And I can kind of right click on here and I can show you this is the XLE. You know what the XLE is? It's the energy sector. Okay, the energy sector year to date performance, all right? Year to date performance is already down 8%. It's not a good year. All right, what's the number 2 decliner over there? That's the XLU. That's your utilities. Hey, wait a second. I thought utilities are supposed to be pretty mellow on the year. That's supposed to be one of the lowest beta products over there. Yeah, it's down 5% year to date. Wait for it. Then we have the XLP, right? What is the XLP? And again, go through some of these. XLP is down. Then we actually come up here to what are our performers? The XLK. Well, guess what? It's your tech stocks. Okay? And on top of that, we have the XLF. For the most part, the two largest sectors, and this is the point that I want to make over here, the two largest sectors inside of the S&P, okay, are performing. Everything else is pretty much bottom of the barrel, falling out of bed. Now think about this for a second, because I want to show you, like the XLE, for example. The XLE year to date was stellar until fell flat on its face and continues to see sell side activity ultimately today. It's dangerous. Things like Walmart have actually taken retail. Okay, if you're not comfortable with looking specifically at Walmart, go look at the XRT, which is retail. Retail is seeing some pretty phenomenal volatility, is not far, though, from the bottom that was achieved just a few weeks ago in the midst of heavy volatility. Need to go further. When it comes down to what's holding the entire marketplace together, do you realize that you can count the number of underlyings, okay, pretty much on one, maybe two hands? Apple, your largest market cap, okay, it's right there. Undoubtedly, you've got Amazon. Now, some people will point out Netflix, but quite frankly, Netflix doesn't have the market cap to do it. Okay, so we've got really, your Apple, your Amazon, which are the behemoth market caps. On the other side of the spectrum, if you want to know, again, what's holding the Dow together, you don't have to look that far. It's called Boeing. And Boeing is exploding to the upside. And again, for every $1 that Boeing moves up, it adds 7 points to the Dow. And Boeing, in just the last couple of weeks, it traded 330 back up to 370. Do some quick math over there and you'll realize, okay, what's actually propping up the Dow. For those of you, again, whether you're an investor or a trader, you have got to tune in to what is really going on in the underlying marketplace. And that is behemoth market caps, okay, are stabilizing the market at this point in time. But if you don't feel like this market is in limbo, okay, you're not seeing the bigger picture. And the bigger picture is we are in a rising interest rate environment. Now, again, I'm in no way, shape, or form. I can't see what holdings you may have. For those of you that are longer term investors, I don't know what holdings you may have. You may have the Amazons. You may have the top performing stocks. But the irony right now is that if you're well diversified, you're not performing well in this marketplace. Okay? And do not let any fund manager, any 401k manager of any kind tell you otherwise. You look at your performance and you need to make a decision and not hold yourself in limbo. And by the way, decisions do not have to be all or none. Doing nothing could cause you substantial risk. But when I said decisions don't have to be all or none, okay? If you're a little nervous right now, get out of portions of your positions. I mean, we don't know anything moving forward. And I said that to begin with. Markets are in limbo. There's no clarity to the future. That's what volatility brings. But one aspect, okay, that I do feel comfortable elaborating upon is that in a more volatile market, you often ask yourself, what's my upside potential versus my downside risk? And right now, okay, I believe in many cases that the risks well outweigh some of the upside potential, especially if you consider us a continuation of a rising interest rate environment. Thanks everybody here for joining us at TheoTrade. Have a wonderful evening. Bye-bye.